So, all right, go ahead whenever you're ready.
I'm Alex,
I'm Connor. I'm Noah.
and not with us today is Michael, but he was also part of the project. We're presenting Diamondback Energy.
And we can give you a brief overview of Diamondback Energy, telling you what the company is about and what they do and everything about it. Then we will break down the revenue and talk about where the main sources of revenue are coming from. We will talk about certain risks, such as technological advancement. We will be comparing their financials to the competitors and how they match up. We will be talking about key growth drivers, such as oil production and natural gas production. We will then explain our valuation and talk about how Diamondback fits into the Spellman fund and why we recommend buying 45 shares. And finally, we will give a summary. Overview. Diamondback Energy is located in Midland, Texas, and they focus on the acquisition, development of oil and natural gas reserves in the Permian Basin, which is located in West Texas and part of New Mexico. They earn their revenue through oil, natural gas, and natural gas liquids, and they do this through a process which is upstream oil, which focuses on mining, drilling, and the manufacturing side. And then when you look at some of their competitors, their biggest ones would be Pioneer and Endeavor Energy, which are the biggest and third biggest producers of oil in the Permian Basin. Diamondback Energy FANG overview. When looking at Diamondback Energy, it is considered a value stock. And it is considered a value stock due to a few things. First, when you look at the recent earnings report, they talk about them transitioning to becoming a value stock. Secondly, when you compare them to the competitors, they are trading at far less of a value, and they also have a very low PE value. Finally, Diamondback Energy has a very strong dividend yield. We recommend buying 45 shares of Diamondback Energy. When looking at the dividends closer, we can see that since 2018, they've had 5 times base dividend growth. They've had average quarterly compound annual growth rate of 10% and total annual dividend yields of 7%. Diamondback Energy FANG. Our recommendation is to buy 45 shares of Diamondback Energy. We believe that Diamondback has an attractive valuation, significant oil reserves, and a strong financial performance with a very strong dividend yield. Right now, Diamondback Energy is sitting around $126, and we have a target price of $146, which would equal a target return of around 18%. When looking at the challenges and opportunities, some of the challenges would be their competition, environmental concerns, and their dependency on crude prices. Some of their opportunities going forward would be land acquisition and new technology. Some of their key drivers that are going to take them forth to the future would be new acquisitions, which would then lead to increasing their production levels in the future. Some of the risks include the war in Ukraine, climate change / political regulations, the switch to renewable energy, and volatility in oil prices. Two of their key risks, though, when you look at it more closely, would be the switch to renewable energy and the volatility in oil prices, which are two things which are out of their control. Diamondback Energy. Looking at Diamondback Energy's 5-year historical stock price, we can see that they had a dip during the COVID times, but then since then they've made a strong recovery and have been stable over the last year. When looking at some of their key statistics, we can see that the PE value has steadily come down over recent years, and their trailing 12 months is around 5.49. When looking at ROE and EPS, we can see that in 2020, they were both negative. And then when we look at 2022, we see that they've both made strong growth in those areas, and the trailing 12 months have both stayed pretty flat.
Yeah, so now I'll be giving a quick overview of the revenue stream for FANG and then kind of dive into the segments that make up the revenue for their business. So the revenue of their business is made up of 3 different segments, which is oil that accounts for about 80% of their total revenue, natural gas that accounts for about 9% of their total revenue, and natural gas liquids that accounts for about 11% of their total revenue. And then when looking at their past 5-year total revenue totals, we can see that they're growing revenue at about 63% for their 5-year average growth rate. And then kind of diving deeper into the segments, how they're performing on their own. So oil is growing at about 63% over the past 5 years. Natural gas is growing at about 120% over the past 5 years. And then natural gas liquids is growing at about 79% over the past 5 years. And we think that these are really high average growth rate numbers, and we think they're really high just because of COVID, when COVID happened, and during the 2020 demand really fell for these products, which caused the price to fall. And then after we came out of COVID, the price really went up and demand for these products went up as well. And then the next slide, we're kind of just looking at the business overview of the revenue streams more specifically. So as you can see, oil is a big chunk of the revenue. In both pie charts, it's taken up about 80% of revenue over the past 2 years. And then natural gas and natural gas liquid is taking up about the remaining 20% of their revenue. So if I can bring your attention to the left side of the screen, looking at the 2022 revenue breakdown, we can see that oil made up for about $7.7 billion of revenue in the year 2022. Natural gas made up for about $900 million of revenue. And natural gas liquids made up for about $1 billion of revenue of their total $9.6 billion of revenue for 2022. And then shifting your focus to the right side of the screen for the 2021 revenue breakdown, oil made up for about $5.4 billion in revenue. Natural gas made up for about $600 million in revenue. And natural gas liquids made up for about $800 million in revenue of their total $6.7 billion in total revenue for 2021.
So moving into the ESG of FANG, obviously this is an oil company, so the environmental effects aren't going to be the greatest. However, they have done some things to remedy this, such as their watering recycling program. They have these pits, above ground pits, where they store water to ensure that they're recycling it properly, and they can test it to see how much chemicals are being put into this water from their operations, which they have significantly decreased over time. They practice electric fracking, which helps with their fracking efforts. They've made it almost a portion of it electric rather than gas powered. They've also done some things to help prevent spills, just to keep the area clean around where they're operating. Socially, they've donated over $3 million to local charities in the past year. They sponsor STEM events in the area, and they've done a lot to help with their appearance for locals, such as noise blockers and appearance blockers. So their drilling operations for the locals. In terms of governance, they have a very diverse board and committees. 50% of these board members are women, and 75% of the chairpeople of these committees are ethnically diverse. So overall, we give it a neutral rating for ESG. Now moving on to the risks. The switch to renewable energy is one of the most prominent risks as of right now. The current administration is moving towards renewable energy as an energy source rather than oil and gas. Additionally, this is an oil company, so it's based primarily on oil prices, which have been volatile in the past, so that could lend itself to some risk in the future.
Now moving on to their financial performance and a 3-year history back to 2020. I want to point out the 2 competitors we chose. We chose Pioneer Natural Resources and
EOG Resources, just because those two companies are also operating in the Permian Basin as well. So we thought this would give a better comparison as they're operating in the same area compared to the overall industry. So first, I want to highlight the PE. You can see in 2022, they've had a lower PE compared to both of their competitors in the Permian Basin, and then also compared to the overall industry as well. Next, I want to highlight the net profit margin. Diamondback is maintaining a lot of their revenue compared to their two competitors and the overall industry as well. Then looking at the PEG for future growth, that value is negative just because the earnings are projected to go down just due to the commodity price. And then looking at the first driver for Diamondback, it is oil production. Diamondback specifically stated that they want to increase production into 2023 by 16%. After that, through 2026, we chose a more conservative and steady growth rate of 4%, just to account for a impending recession. We still think the demand will be there, but we do want to slow it down. And also for well projections, we did grow this at 4% as well. It is a little higher than their past growth rate for wells, which is around 2%, but we bumped it up a little bit due to their large acquisitions in the past couple of years. And then this is also assuming that the price per oil or per barrel of oil is between $65 and $80 a barrel. Looking at the EPS calculation for the oil segment, you can see it does decline through 2026 just due to the price of oil. How we calculated the price of oil into the future, we took the average from the futures market for each year, and that's how we calculated the price. So here's how we came to our EPS for the oil industry. We found the barrels produced per rig, then we found the earnings per each rig that Diamondback has, which gave us total oil earnings, and then we were able to get our EPS from that number.
Then the second driver that we decided to look at was natural gas and natural gas liquid production. So FANG stated in their investor presentation at the end of the year that they were planning on increasing production of natural gas by 9% for the year 2023. And then after that, we also decided to use a constant 4% increase for the years 2024 through 2026, as they have stated that they are planning on exercising their capital discipline within the next couple of years. And then for well projections, we also we decided to do a constant 4% increase in number of wells for the years 2023 through 2026. We did this because looking at historically, FANG has increased their number of wells from anywhere from around 2% to 4% each year. And this year they did explicitly state that they were going to increase their number of wells by 4%. And then we assumed natural gas prices would be, and this is in terms of barrels of oil equivalent, this would be in a range of $19 to $28 for the years from 2023 to 2026. And we found this number just by looking at what the futures market suggests and kind of basing it off that. And then, so this is our estimates for natural gas for 2023 through 2026. You can see initial decline into 2023. We did this because we are taking into account the fears of a recession. A lot of people are expecting an economic downturn coming up in the next couple of years. So we have a natural gas price going down to $19 per barrel per BOE, but then we have it ramping back up, and it actually almost makes its way back to a parity from 2022. From 2022. And then the way we calculated with this, it was pretty much the same as how we calculated the production for oil. So we found thousands of barrels of oil equivalent per natural gas rig, which is production in 1,000 barrel of oil equivalent divided by the number of natural gas rigs that the company has, which then we found our earnings per rig, which was the barrels produced per rig times our projected natural gas price for that year. And then we found our total earnings from natural gas, which was our earnings per rig times the number of rigs that the company owned. And then finally that gave us our EPS, which was our total EPS earnings divided by the number of shares outstanding.
So now moving on to the valuation, you can see both of our EPS numbers combined here for our total EPS, combining both oil and natural gas. It does decline slightly. And again, this is due strictly because of the commodity price for both oil and natural gas. And then you can see our baseline EPS, which was on the last slide, compared to our optimistic and pessimistic scenarios. Optimistic is obviously having the commodity prices increase in price, which will give Diamondback more revenue. And then pessimistic, we have the commodity prices for both oil and natural gas falling. And then looking at the target price we have for Diamondback, we have a baseline price of $146. How we came up with this, we chose to allocate more weights to the discounted cash flows method, just because we thought this was a better indicator for the oil industry and for an oil company, as their fixed assets do last a while and generate a cash flow for the company. We chose to allocate less towards the PE just because their PE has varied in the past with their acquisitions and with times like COVID as well. And then you can see our pessimistic and optimistic price as well, going up to 206 for optimistic and down to $111 for pessimistic.
Looking at the portfolio fit and correlation matrix for FANG, obviously it's got a pretty moderate correlation with the fund, as with many of the stocks within the fund. Exxon is the largest correlation, which makes sense. They do a lot of similar things. They're a big competitor of FANG. The fund is currently underweight in the energy sector, and we think this would be a good sector to increase the weight of due to oil demand remaining pretty positive. You look at things like cargo ships, airplanes, construction equipment, all use gas, which we don't see changing in the near future. And that leads us into our recommendation, which is, as we stated before, 45 shares. This would be about 1.4% of the fund. The energy sector would rise to 4%, which is just under the 4.6% of the S&P 500, which would cost a little under $5,700. And we have a target price of just under $146 and target return of just under 18%. So as we talked about, FANG has had fast historical growth and are looking to become more valuable in the future rather than growing. It's got low PE value. It has little debt, and with a high dividend yield and dividend growth, we think it would be a great investment for the fund.
We can start with two hopefully simple ones. And this is my clarification. Are wells the same thing as rigs as you
Yes.
described on the page? On the dividend, explain the dividend payout. Is it consistent baseline, or do they have a variable dividend based on their free cash flows or the cash flows for that given year?
Yeah, so they have a base dividend that they give out, and then they do have a variable dividend that they will add on to the base dividend based on how they're doing throughout the year.
And did you tell us what the baseline dividend was? I mean,
We did not, but for last year it was $3.
what is that on a yield?
It was
2.3 for the base.
Yeah, oh yeah.
One quick follow-up is, how long have they been doing the variable dividend, do you know?
Pretty much since they started giving a dividend, which was 2018.
Thank you.
Since you talked about it, I got burger in my mouth,
It's
So-
cool.
pretty much. Lucky Charms. So you said the yield's about 7%. roughly. Of that, 2.5% or whatever the number was, 2 and change is the baseline. So you're looking, rough math, we'll call it a third. A little bit, maybe less or more, it doesn't really matter, is what you're gonna do every year. That variable is the swing factor. What's that variable? How do they determine what that variable factor is? Because that's a big chunk of their yield. And where I'm going with this is, if we buy this on the board, if you're saying it's got high dividend yield and growth, we're banking on that piece of the variable. So we should be scared that we can keep that, or is it actually going to grow? Like what's the likelihood of that changing? And what's the driver behind that? You have to understand that based on your strong statement of high dividend growth and yield. So what's that variable? Short question, what's the variable yield based off of? And how does that tie into all the various expectations that you guys laid out with oil and gas prices?
Yeah, so it really depends on the price per barrel of oil. Obviously, a higher price is going to give the company more revenue. So we're a little more optimistic on the price per barrel being higher just with OPEC and what they have decided. And they've kind of hinted at too that they want the price per barrel to be upwards of $75 per barrel. We did calculate a break-even price as well, per barrel of oil. That kind of shows that Diamondback can still pay out what they did this past year. At, it would be $28 per barrel, and that does include the natural gas price as well.
That's your break even, but the current dividend break even is 48.
How do you read that slide?
Sorry, so the one in parentheses would be the break even if you're just looking at oil prices, and then the one that are not in parentheses would be break even in terms of total revenue for the entire company.
So taking into consideration nat gas.
Yep.
So if you take into consider the nat gas piece, oil can actually go down to $39.
Correct.
That would be in terms of dollars per barrel of oil equivalent. So that's taking natural gas, which is, so natural gas is priced in terms of cubic feet.
Yeah.
And so to bring it all together, they make it in terms of barrel of oil equivalent, and they price it in terms of dollars per barrel of oil equivalent.
I'm gonna focus on the oil because it's simpler. All right, so basically, they can keep paying their dividend as is stated. Until it hits 48, then they'd have to worry about cutting it.
It would, yeah.
That's how we read it.
That's the base dividend. So anything above 48, there's some kicker.
But we don't know exactly how that's. Have they given any guidance as to what their future dividend payout projections are? Because do you guys have an actual price of oil over the last 5-10 years?
Yeah. We have it over the past 25 years.
Okay. So you've seen, do you know when they've introduced, I don't want to take up the whole time on dividends, but I think it's kind of one of your talking points, right? So when did they introduce the variable? Do you guys know by any chance?
2018.
So 2018, okay. So you've seen a nice pickup with the price of oil. I guess my concern is that how much that's when oil prices is going up, and then if oil price is rolling over, you're basing it off of historical growth.
Yeah.
But if prices are rolling over, are you still gonna have that historical growth? That's
So
where my head's at.
So just looking at their base dividend, they have, since that 2018, they have increased their base dividend 540%. So they are, and from this year, from last year to this year, they are focusing on, they want to increase their dividend from $3 to $3.20. So they are showing growth in their just base dividend every year.
That's the variable, that's the kicker, that's
Yeah.
the bigger piece that we have to worry about. Okay, I'll stop there.
So how much of their free cash flow are they targeting to pay out?
So they have a goal every year of paying out 75% of their free cash flow to their investors.
You go to your risk slide. Is page 7. Yeah. Russia, Ukraine. Is the risk that war continues, the war ends?
I think it's mostly for the war, the war coming to a close, like getting the intensity of the war going down,
What does that do?
because that would give a little bit more stability with Russia in terms of oil demand.
Russia is such a big supplier of oil in the world. I believe they make up roughly 11% of the total oil market. So with so many countries placing sanctions on them, that drives the price up, just because they distribute so much oil.
And then go to page 20. We have a lower return on maybe 21. I'm sorry, 19. Comparables. Sorry, slide 11. This is why I write good notes. Return on equity. So return on equity, as I look across, 30. But when I compare it to Pioneer, EOG, and the industry average, it's low. Connor already answered this, but he didn't know. Why is their return on equity, why might their return on equity be lower than some of the other peers?
I'm not sure.
I gotcha. Return on equity, so return divided by equity. How could we increase the ratio? There's two ways to do it. Right? So we're either gonna increase the return or decrease the amount of equity. If we were to decrease the amount of equity, what would be the alternative? How do we get to there?
I know, and correct me if I'm wrong here, but they are focusing on doing share buybacks. I don't know if that
That's part of it. So they're gonna decrease the amount of equity by buying back shares, or you said they have low levels of debt. So I'm assuming they have lower debt levels than their peers, which is why they have great numbers everywhere except right there. So sometimes it's positive to have low debt, but it makes some ratios maybe look a little worse. So if I'm looking at this, that one stood out to me. And at the end, low levels of debt. Maybe that's why the return on equity isn't as good, is because we're not as highly levered as maybe some of the other names are. So
The debt to equity. Last line.
and I could be wrong. It could be the return piece.
Well, that's the question I had, was that you said they had low levels of debt, but I'm not a debt guy.
How should we read that ratio, the debt to equity?
so that's a total liabilities over their or total common share.
So it's 71 times the amount? Is this a fraction? Or is it 71%? What number are we looking at?
It's 71%.
So compared to their peers, they have a higher ratio of debt to their amount of equity. How does that jive with the statement you made that they have low levels of debt? That's where I was confused.
And I'm confused too now.
Oh,
Because we looked at it, it looks like they could pay off their debt with 1 year's free cash.
And we were looking at, they can do that, but when looking at Pioneer and EOG, they do have like less debt than us. So
only we had the professor.
There's a formula we're missing and a whiteboard.
Anyone here taking CFA level 1?
Yeah.
Looking right at me.
Yeah, this is something you should be able to explain to us.
Are we? Or
Anything, Eric, tell me what the hell's going on? I said this 20 some years ago, I don't know.
I mean, if you have higher leverage, you should have a higher ROE. So, I mean,
Which is counterintuitive in this model here.
yeah, the debt to equity doesn't really make sense with the ROE numbers there.
I got a different question. Looking at your projections for future production. It seemed like you went to the high end of the range in terms of number of new wells. You explained it by they just acquired a bunch of land. So a two-part question. One, do they need like permitting to drill on those lands, or are they already, is that available to them if they want to? That's the first question I'll follow.
I do know they do need permitting. I don't know the full aspect of it. I just do know they do need that.
Do you feel like that's gonna be a barrier, or they will easily be able to increase production as you had projected?
If you just kind of look at their past, the way they've increased like production, it seems like that hasn't really been a barrier.
Okay.
I don't think it should be in the future.
You know, with their past acquisitions too, like over the past 2-3 years, they've made pretty big acquisitions of different companies operating in the Permian Basin. So that already gives them access to that land just by now owning that company.
So over the last, say, 5 years, you know, price of oil, well, actually over the last 10 years, price of oil had fallen in the mid-teens. Energy companies generally reduced their production. Then COVID hit and we had this demand kind of washout. They all were on brink of not being profitable, and then a huge supply and demand imbalance post that with the war. Things seem to be more normalized. You seem to be projecting that they're going to be aggressive in their future production. What makes you feel like they'll be able to successfully increase their production relative to peers. If we have more stable price of oil as we project.
So the Biden administration actually said they're going to continue to up the production in the States. I believe by the end of this year, it'll be a record for like production ever in the country. So I guess that also plays into it as well. I mean, typically with a liberal government, you're going to see production cut back, but that hasn't been the case so far with this administration.
Okay.
We talked about rigs. Have you seen anything on? So, you know, you're basing your projections on production per rig essentially. What about, what's the volatility of rigs? Like, how often are they coming on? How often are they coming off? Fracking, there's been, you know, wells tend to roll over faster. That's probably in some of their production production projections that 5 times fast, burger in your mouth. How quickly do they, like, how many rigs do they have? What have you seen historically? What are their projections for? Because that's gonna, based on your numbers, that could affect your projections, right?
I believe we have the rig count down in the appendix. So, yeah. And you can, so right up here, you can see in 2021 and 2022, the amount of rigs that they've had.
So 81,000 rigs.
No, it's the
What am I looking at? Oh, sorry.
middle one there. It says
Oh,
number.
okay.
of years.
Yeah. You guys have a clicker thing with like the red
We're not
laser
going
light?
to. Should do.
You have the laser light on?
Oh, yeah.
Yeah, that might be helpful. Yeah, there we go. Okay, so what are you looking at? So the number of rigs, so we went up 200. So you're gonna go up another, so basically consistent rig count. And are those projections yours or do those come?
Those are ours.
Okay, and what's the philosophy behind that?
So, like we said in the presentation, in the past, they have consistently increased their rigs by 2 to 4% per year. And then we just think, with their like increase in production, 4% was a decent number to.
Have you read anything in industry wide as far as what rigs are doing or what kind of any other projections that are out there besides just kind of historical? Like, and what I'm thinking about is just, again, volatility of oil prices and how that's gonna impact their decisions. Like, is there like a correlation between oil price and the amount of rigs so that you know, okay, if prices roll over, you should actually, instead of a 4% growth rate, maybe see flat to possibly down, or, you know, let's say prices go back up to 100, then you're gonna see, you know, growth, because, you know, as you know, a lot of this is all tied to whatever oil prices do. It's not gonna be a constant state GDP type growth. So I'm just kind of curious what you see.
I guess we haven't read anything specifically about like historical, like how many rigs I have when production is higher or anything like that. So it's something we'd have to look into.
You said they were gonna exercise caution, but with respect to future capital investments, they're gonna rein that in a little bit, or at least what was it in 2022 and what does 2023 and beyond look like in terms of those capital expenditures, the large capital expenditures?
So, I believe in 2022, they had capital expenditures of about 1.6 to 1.9 billion. And for 2022, they've expressed that they're gonna have capital expenditures from around 2.2 to 2.4 billion.
It's a little bit of a ramp up.
Yep.
And that they did state that's gonna be for rigs and wells.
Yeah, it's gonna be rigs, wells, and then it's a small chunk of it's midstream, focused on midstream, and then infrastructure in the back.